out of the way. All right. So one of the things it means though is that I'm left-handed, so I'm not writing any notes this whole session. So we're gonna just do our best here. All right, some housekeeping as we get rolling here. This event is approved for 1.0 CFRE credits. We've added a question to the end of the survey to certify your participation, so just fill that out. Here's the agenda. As usual, you will get the recording and the slides after the fact. Please just fill out that survey at the end so we know you're here, and that way we can send it to you. That's a big component of it. What are we going to do? We're going to do quick intros. We're going to talk about where the world is in terms of assets and stock markets. We're going to talk about the latest trends and some very new research in stock giving. We're talking about strategies to grow stock, and particularly in time for tax season. And before we do this, just as some intros, before we do intros even, just to put this in context, a lot of you, you'll see in a moment, there's a high degree of anxiety in the nonprofit sector right now, mostly due to the pause of federal funds and the sort of unknowns that are happening from there. So we thought about maybe we should do a different session. Maybe we shouldn't focus on stock giving. Maybe we should talk about something else this time to help you navigate that. And it's a really interesting dynamic where, yes, there are some things we should be doing differently there. Next week, we're going to do a very specific session on how to diversify funding in light of uncertainty, especially in federal funding, right? So many of you may depend somewhat on federal funds. Some of you may not at all. But in any case, there's high variance. There's actually going to be a lot of new federal funding in different areas. There's going to be removal in some. Foundations are going to change. A lot of this is going to scramble. And so there's some case to be made that you should do everything differently. But one of the other things to know here is there's this concept in the NBA, National Basketball Association, called hero ball. And one of the things that happened in the 90s, really before analytics and into the early 2000s, is that the game would be close and they would just give the ball to the best player. And that best player would try to do their best and then hit this shot at the buzzer. And you remember when it worked, but actually it didn't work most times. It was worse than running the basic offense that you were running the whole game. And so what we really want to do is avoid being in hero ball world where we just like scramble all the things we were doing. And instead, we want to do the things that we know to work and do them really well. So that's a little bit of the thesis behind why we're doing this right now. There are a bunch of things that have been absolutely proven to improve fundraising, and stock giving is one of the most important things. So we'll talk about that in a moment. So those of you remember some of the great hero ball moments, but for the most part, when you do the analytics, it's actually a losing strategy. So there you go. All right. So quick intros. My name is Patrick, lucky to be the co-founder of FreeWill alongside my wonderful co-founder and co-CEO, Jenny Shia-Spradling. Again, I'm in New York. Jenny's all the way in Seattle. Another fun thing is that a week from today, we're actually going to go speak at Stanford together. So it's our alma mater. And those of you that have MBAs or are familiar with business school know the case method. And there's a new case at Stanford University being developed about free will. So we're going to go present that. And we're very excited about that. FreeWill is the #1 estate planning and plan giving solution trusted by almost 2,000 nonprofits, including many of you. Thank you so much to those of you that are part of the team. We're really grateful for you, and lots of good press and lots of great customers along the way. FreeWill team is more than 230 people now, 220 people, I think, in 3 continents all around the world. A couple of shout outs here. My colleague Phoebe has put a ton of work into this. Other colleagues, Christina, Bianca, Dina, others put a ton of time into the research that we're doing now. And so there's just a lot of effort by a lot of folks that goes into the things that you're seeing. You can see me in the middle, smiling in that black shirt. Phoebe, who put a bunch of effort in, she's towards the right. You see my colleague Danielle, big picture up in the top right. She's 3 down. She's been great. A lot of wonderful folks that put a lot of effort in here. Raised more than $11 billion to date and over 4 centuries of combined fundraising experience. All right. Before we get started, one more thing. I mean, look, in case it's not clear, we really love you guys. We're so glad to be doing this together and helping out. We always try to help you be a little bit smarter. And one of the things that I've read that I love is this book called The Psychology of Money. It is not about greed. It's about sort of general human interaction and human behaviors. It's a really helpful thing to think about if you're ever talking to donors. It's also a really helpful book to have if you think about when you should be saving and when you should be spending, and what cognitive biases you might have around money and what cognitive biases I have around money. So it's a great book. It's only a couple hundred pages. It reads super well. Shelley read it. Kara read it. Great book. So by this gentleman named Morgan Housel. We'll send it to 20 people as a gift. If you're interested, let us know in the survey, not in the chat, please. Amy says it's on her bookshelf. Now feeling motivated to start it. Amy, it's a great read. Read it for 10 minutes and you'll probably want to keep reading it. Great, great book. Money is it's such a core part of people's lives, whether you value it or don't, right? It's sort of it's the exchange of goods and services around the world. And so just having a little bit of insight into how you're thinking about it and how other people think about it is quite helpful. All right, so a couple things to note here. How is your week? This is the first week, I think, since COVID in March of 2020, where you see that yellow line of anxiety pushing above as sort of the top experienced emotion. So I just want to acknowledge that. If you're feeling that, you're not the only person. A lot going on in the world, just naming where we are here. Obviously, people aren't feeling that lonely, which is great, but overall, there's a decent amount of anxiety to go around. So hopefully, anxiety often comes to be in moments where things are changing and we don't know what to do next. And in many ways, once we feel like we have a plan and we can start putting in action, then we really calm down and get back into that flow state, which is the core part of happiness. And so hopefully this helps, but just something to keep in mind. Interestingly, as anxiety is up, so is people's confidence in hitting their goals this year. So people are feeling like, yes, we're going to do well this year. Many of you we've talked to have had a very strong January, and I'll show you some numbers about January giving later in this session, but it's going to be a good year for giving. And yet there's obviously a lot of anxiety across the board. Simon asks, what's the source of this data? Simon, we actually survey folks every other week to get this data for you. So very helpful. Ooh, Andy says, is there a FreeWill book club list somewhere? I wish I wrote the names down. Great idea, Andy. We'll do it in the future. Great idea. We asked you on a scale of 1 to 5, 5 being the most common. How do you feel about stock giving? Almost a perfect triangle here, right? So most of you say I'm a 3, I'm in the middle. Exactly the same say 2 and a 4, and almost exactly the same say 1 and a 5. If you are a 5, feel free to shout out in the chats, things things you want to add to the conversation. Please do that. If you're a 4, same thing. If you're 1, feel free to add your questions, and people are here to help you out. Micah says, here for a book club. If anyone needs a great read, not The Psychology of Money, I'm reading a book right now called, what's it called? It's called A Swim in a Pond in the Rain. Some of you have read that. So good. It's a collection of Russian short stories and commentary on them. It's not as wonkish as it sounds. Anyway, give that a shot if you need something to sort of center yourself again. All right, back to the work at hand. So we are putting out our 3rd ever stock report. We're doing this annually. We will continue to do them annually because we think this information is so valuable to bring to the sector. It is a ton of work, mostly not by me, almost entirely not by me. So I just want to shout out everyone who worked on it. We looked at data from over 15,000 nonprofits. We untook a ton of 990 data, both manually and with technology that we built. We had to do things like look where, this small organization in Oklahoma said they got 67,000 stock gives. It turns out that's actually $67,000 and they made a mistake. And so there's a lot of manual work that goes into this. We looked at the most available data, which is only 2022 and 2023. So we're going to see some big trends from those years. And then we're going to augment it with other access to data that we have that's sort of the first look at 2024 and 2025 data even. So you'll look for that as well. So the 990s obviously lag behind. When you see things like the giving report, these are always a year behind or more. So just to give you some context there. We look at stock giving by sector, by geography, by organizational size. And we hope that this report helps your team identify where your org fits within sector-wide stock giving trends. So it's not just how am I doing compared to Johns Hopkins or Harvard, but how am I doing for an organization my size? How am I doing for an animal organization or a religious organization or a college, et cetera? So we'll do that. A couple quick terms as we get started. What are stocks? We're just going to talk about stocks as a shorthand for a type of investment that represents an ownership share in a company. Other things that we actually call stock giving are not stocks, they're mutual funds or index funds. Index funds are a subcategory of mutual funds, or ETF, which is exchange traded funds. This is an investment in a group of stocks or a single stock. These have become extremely popular, especially the low cost ETFs like Vanguard over the past few years, because effectively, economics have shown that these have the same expected return as individual stock with much lower risk. So that tends to be quite, they become a sort of a favorite of investors. Securities are a catch-all term. So really, when we talk about stocks, sometimes we mean securities, bonds, mutual funds, ETFs, other types of investments that you can buy and sell, often with a liquid, publicly available market. Capital gains taxes, if you don't know, well, now you know, these are a federal tax on profits realized by the sale of an asset. So that's really important. Note that many states have an additional capital gains tax, or they just treat it like income. So I'm in New York City. When I sell stock, I pay federal capital gains taxes and I pay state income tax on that. All right, let's do a quick look back. So hopefully you all know that. Let's just check in, right? Because the news can be confusing because it's overreacted to the week or the month. At a macro level, the S&P 500, which is one of these big indices, which measures how a large collection of stocks are doing, and the Dow Jones, which is a collection of a smaller number of stocks, are trading near all-time highs after strong gains in recent months. Why? Why is this happening? Well, there's a million reasons, but a couple of them are tech stocks. Tech stocks are seeing major growth. They have been an enormous driver of the overall market gains over the last few years. The Federal Reserve could possibly cut interest rates later this year. Interest rates are inversely correlated with market growth historically. And there is a large-scale macro bullishness on AI. So many people think that AI is going to lead to a massive growth in productivity, in profitability, and overall just human advancement. Obviously, there are some downsides. This is not a session on AI, so we will dive into that at some other point. What else do we know? People are extremely heavily invested in stocks. Despite concerns over tariffs and company earnings, investor confidence is quite high. When investor confidence is high, it is a belief in what the future holds. And really, a belief in what the future holds is what tends to dictate stock prices. A strong stock market creates opportunity for nonprofits for even bigger gifts. If I'm going to give you one share of stock, it's more important for you if stock is worth $15,000 as opposed to $9,000, right? So a rising tide tends to lift all boats here. And one of the biggest takeaways, the most important things about stock giving is that these gifts are much larger, much, much larger than cash gifts, typically 10 times larger, oftentimes 100 times larger. And so we'll dig in a little bit more there. Okay. Now let's just sort of, 2022 is a long time ago. So we're going to look at some of the data there, but we're going to carry ourselves back. 2022 actually a tough year for the market, right? After a very strong 21, the S&P 500 fell 19%, making it the worst year for stocks since 08. High inflation, rising interest rates, economic uncertainty were all contributing factors here. 2023, a strong rebound, 24% back. So if you invested at the start of 2022 and your money all dropped by 19%, you took it all back by 2023. 2024 record-breaking growth, another 23%. And I think as of this morning, we're about up 4 points on the year, 3.5 points on the year already, which translates to pretty healthy 2025 projections as well. You can see that over the last 5 years, you have an 80% growth in the S&P 500. This is pretty considerable, right? Savings accounts are in, savings accounts are out. A lot more people are putting money that they need in investment funds over time, and it grows. Okay, so those are some of the basics of stock. But this isn't just like Econ 101. This is a session on how to be better fundraisers. And so why is it so important that we should be excelling at stock gifts? Well, when you think about life as a nonprofit, stock gifts tend to be enormously important. And it's not just that the sort of logic of this, right? It's that we are when we look at millions of IRS 990 returns from nonprofits, we saw that nonprofits who accept appreciated securities, again, securities means stocks, bonds, et cetera, grew by 2/3 over a 5-year period. because donors who understand the tax savings are likely to give again, and they're likely to make larger gifts through stock compared to cash or a check or credit card. The average cash donation is $100, and the average stock gift is $11,500, or for those of you keeping track at home, 115 times larger. So one stock gift equals 115 cash donations. And the key here is that it's often from the same people. So yes, your wealthier donors are going to give you stock more often, but even those donors will give you vastly more when they give stock compared to when they're just giving cash. So why do donors want to do this, right? Obviously, it's better for nonprofits because it's just more money, right? So we'd always rather have larger gifts instead of smaller gifts. But why does this benefit donors? Well, the core of it here is that donors who give stock save on two types of taxes. If I give a stock directly to a charity, I avoid all capital gains taxes. I often avoid all income tax on capital gains from my state, right? So if you're in New York City and you're a top earner, you might be saving 33% alone there. And then I receive a full federal income tax deduction for the full present value of the stock. And in some states, I'll receive a state deduction too. So suddenly I could be saving more than 50 cents on the dollar by giving stock. I mean, this is really remarkable. And so it's one of the most important ways to give and highest impact. Just as a sort of case study here, Diana and Jonah are $50 a month donors to Habitat for Humanity in their local area. And they want to increase their giving this year, but expenses are a little tight. They receive an email from Habitat this tax season, right? April, March, April, May, educating them on why donating stock is the smartest way to give for many people. They decide to give $5,000 in appreciated stock directly to Habitat for Humanity. This allows them to skip paying significant capital gains on this and get a charitable deduction, lowering their, this should say 2025 bill considerably, or if this happened last year, it would be 2024, right? So it lowers the bill, not for the year you pay taxes. You obviously pay taxes the following year, but it lowers your tax bill or your sort of overall tax liability for that year. So let's talk about, okay, well, that sounds great, but like, do my donors even have stock? Who owns stock in America? Well, it turns out a lot of Americans own stock. 62% of American adults, this is everyone over 18, right? So this counts all the 19, 22-year-olds who have no savings at all. 62% of American adults own stock, highest level of stock ownership since the Great Recession. Direct stock ownership is back to pre-2008 levels. Direct stock ownership means I own stock, not just I own ETFs, while total ownership, including mutual funds, has exceeded it. Highest ever levels of stock ownership in world history. Ownership hasn't declined since 2016 and has expanded every year since 2020, meaning in some cases some years it stayed about even. This is a really big deal, right? When we really want to understand trends because we understand not only where we are now, but where the world is going as well. And so we expect stock ownership to continually increase here. Stock ownership demographics. So who owns this? According to a 2023 Gallup poll, 74% of folks who are married own stock compared to 48% of unmarried people. Some of this is correlated with age, right? Married folks on average tend to be older than unmarried folks, but not across the board. More women than men own stock. A lot of people get this wrong, but 62% of women compared to 59% of men. 84% of higher income Americans, meaning folks that make over 100K, own stock, and 63% of people making between 40 and 100K. So really, your entire donor base is in the stock ownership world. Most of your donors are not making less than 40K a year. More than 80% of college graduates own stock. So if you think my donors went to college, well, it turns out that 8 out of 10 of them are likely to own stock. What else do we know? There's this myth, right? Sometimes people say, well, I have a lot of younger donors. Should I be talking about stock giving? And it's a myth that only boomers own stock. In reality, stock ownership is rising among younger generations. 41% of adults ages 18 to 29 own stock. I mean, this is really remarkable for a generation and a decade that is just beginning to save. 67% of elder millennials and Gen X, right? So many of you might be in this category, 30 to 49. 66% of folks 50 to 64. So this elder millennial and Gen X is actually the most likely to own stock. And then you have obviously quite high ownership among folks over 65. 63% across the board. So really interesting. What does this mean? What is our takeaway here based on some of these numbers? Let's go back to this for a second. How is it the case that 30 to 49-year-olds are the biggest owners of stock? Well, it turns out that this is a very financially savvy generation. They grew up with access to a ton of information thanks to growing up with the internet. There's a higher college population, and we know that college positively correlates with stock ownership. And so what is this likely to mean? It means that in an ongoing basis, more and more donors are likely to own stock going forward. And despite expanding ownership, boomers still own the most wealth, right? So a lower percentage, but the boomers who do own stock own more of it, right? Boomers are the largest and wealthiest population in the history of the United States. While your average stock donor may skew older, that is likely to change. And so we want to understand the wealth patterns along with the giving patterns that can help us predict future trends, right? So this is quite helpful. Many of you have heard us talk about the Great Wealth Transfer. The Great Wealth Transfer is the biggest transfer of wealth in the history of the world. It is about $83 trillion. Excuse me. It will shift significant wealth sitting in stock and mutual funds from boomers to millennials. Also, by the way, hopefully much of that will go to charities. This is going to reshape donor demographics and will directly influence your major giving strategy. Aging and older boomers will seek to liquidate stocks in future years as work income is replaced by investment income. And by the way, it will be much better for them to give you stock and keep their cash than to liquidate stock, pay the capital gains, and spend the cash they already have. So what else do we know? That's the big background on stock giving, right? So we know the markets are in an incredible place for stock giving. We know the demographics are an incredible place for stock giving. We also know the markets have been up and down. And so we're going to look at what we learned in 2022 and 2023. Insight one, so huge number in 2021, and then drop from 2022 and 2023. In 2018, 9,000 nonprofits reported receiving stock gifts. In 2020, that number is hovered around 7,000. In 2023, nonprofits raising less than 5 million were underrepresented in stock giving, as fewer of those orgs reported receiving gifts. So smaller orgs are reporting fewer gifts. Now, a quick note here, it's my understanding that reporting kicks in at 25K. So some smaller orgs are getting stock gifts, but they might not be reaching that $25,000 threshold where it starts to show up on the 990s. You can see here in terms of total organizations reporting stock gifts, you've got a bump in 2022, down 2023, but 2018 and 2019 were higher. Remember, 18 and 19 were banner years for the market before a big crash in early COVID and then picking back up. So really, really interesting stuff as well. Okay, insight two, stock giving declined year over year. This is 22 to 23. Total stock gifts fell by 24%. Both the number of stock gifts and total value declined, meaning fewer donors gave stock, and those who did gave less. They were evident across the 10 top sectors that we looked at. We'll show you these in a moment. And in most major nonprofit categories, every sector within the top 10 dropped except higher ed, K-12, and environmental, right? So higher ed, K-12, and environmental all saw a rise while others fell. You get a sense here of the overall money. So what you see here is a drop from 2018 to 2020, and then a big jump in 2021, and then a drop again. And so you see these big moments in the market. But let's be clear, $8 billion is still a lot of money. And this number is likely understated because there is some stock giving that is not reported. So there's a much larger number likely to be the case. You see number of stock gifts. 2021 was a huge year for the market. And you see how many individual stock gifts got made there. So really wild 2018 as well. Nice to see this all over the place. This is a time where you see a really good time in the market, a really strong year leads to a ton of stock giving. Just a little tip, 2024 and 2025 mirror the economic performance of 2021. So we should be gearing up for really big stock giving years. Now, sector specific, higher ed tends to dominate stock gifts, but you also see things like arts and culture, healthcare, medical research, animals, environment, et cetera, right? So these are all true in 2022. And then 2023, just going back and forth between these two, K-12 is the one that made a big jump, right? So what's likely to happen there is you have some big gifts to a couple of places that's moving it up and down. But overall, we should be doing this. Now, the question here, and we'll talk about this as we get in a moment to larger orgs versus smaller orgs, is it the case that there's something about higher ed that makes people want to give stock to higher ed so much more? And as far as we can tell, the answer is no. So why is higher ed so successful? Higher ed tends to be the place where you have, frankly, the most sophisticated teams, with apologies to everybody else. They just tend to have the largest teams, in part because they have a very large donor base of alumni, particularly at sort of elite higher ed. And they're smart enough, not the other teams aren't smart, but they've really caught on to this idea that stock giving is how you get the big gifts. Now, why is higher ed advancing farther than everyone else? Well, it tends to be that there's these sort of somewhat insular conversations, not that they're excluding other people, but organizations like CASE do a really good job of fostering innovation within the higher ed space. And so more and more of these people are asking. The number one correlation with who's getting stock gifts is who is asking for stock gifts. And higher ed tends to ask way more than anybody else. And so, it's a little tip here to be more like higher ed. When we ask you how you anticipated stock gifts in 2024 compared to those in 2023, most people say either about the same or somewhat increase. More people say significant increase than somewhat decrease. Now, giving in the market aren't directly tied, but they do have a strong correlation here. So just to put this in perspective, the S&P 500 grew by 24% in 2023, yet stock giving still declined. Why is that? Why would that happen? Well, when we look at that 24% number, it's a little misleading. Why is that? Most of that growth happened in November and December. So actually, most people didn't think they had wildly appreciated assets until the end of the year in terms of year-over-year gain. And remember, 2022 was a down year. And so you're just climbing up, right? So you didn't actually climb out of the 2022 decline until very late in the year. But in 2024 and 2025, you have sort of steady gains and 3 years of steady gains across the board. What it tells us is that positive market performance is not enough to motivate asset-based giving, but things like donor education, tax motivations, and tax law and timely outreach play an even bigger role. Stock giving tends to lag behind market trends, meaning nonprofits shouldn't assume that rising stock values will immediately translate, but rising stock values 6 and 8 months ago is actually a pretty good proxy. So we can actually look back 6 and 8 months and say, oh, wow, we've been really killed it over the summer of 2024, the fall of 2024. 2025 is going to be a very big year. Now, what else happened over the last 8 years that affected stock giving? Well, there's one enormously important trend. Nonprofits now must compete with donor advised funds for stock donors. This is incredibly, incredibly important. There's a large number of donors who are donating stock, but not giving in traditional nonprofits. Where is that stock gifts going? It's going to donor advised funds. In 22 and 23, as well as most of the years since 2018, stock giving to DAFs really outpaced stock giving to nonprofits. It's an ongoing trend that we uncovered in previous stock reports, and most people haven't seen how vast the contrast is. So we're going to show it to you now. So what does that look like? In 22, $35 billion, capital B, was in stock was given to DAFs compared to 10.5 to nonprofits. In 2023, $20 billion in stocks was given to DAFs compared to $8 billion in nonprofits. According to Fidelity Charitable, 57% of contributions to DAFs in 2022 were in the form of non-cash assets, such as stocks. So let's just put a finer point on this. Remember we talked to you about higher ed dominating stock giving? You know who else is dominating stock giving is donor advised funds. 63% of all funds going to DAFs is non-cash gifts. Now, what's the magic here? The magic here is that they're asking for these gifts. This is a really big shift. This is an enormous thing to understand. And so the big takeaway here, we'll talk more about this in a moment, is that we should be asking for donor advised fund gifts and we should be asking for stock gifts in the same sentence. Because sometimes what's happening is people don't know they can give you stock, but the donor advised fund is saying, hey, give us stock. And so water flows downhill here, and they will give stock wherever it is easy to do so. Ultimately, they want to benefit you. And yet, if we need to make sure that we're asking for folks, because otherwise they'll just give it to the folks who are asking. Now, stock gifts are concentrated because some organizations are saying, wow, this is just the ticket to growth. We are going all in on stock giving, and other organizations are getting left behind here. The top 10% of nonprofits control nearly 60% of the total stock value. Nonprofits raising more than 10 million represented 22% of orgs and 70% of stock gifts. Excuse me. While those raising less than 10 million are 60% of orgs who 60% of orgs who announced that they got stock gifts, but only 10% of total gifts. Stock gifts to nonprofits raising under 10 million dropped by 7% year over year. They received 1.2 in 22 and 1.1 in 23. Orgs raising under 5 million make up 45% of orgs reporting receive only 7%, about 1.35. Large institutions that likely have major giving programs have been the biggest beneficiaries of this form of giving. Now, this is interesting, but basically it comes back to this question of you don't get what you don't ask for, and you do get what you do ask for. So when we look at nonprofits that raise the most stock, you won't be stunned to see some of the names on this list. Johns Hopkins University, top of the list. The Board of Trustees of Leland Stanford Junior University, or Stanford for short. Second on the list, Michael J. Fox for Parkinson's research. UCSF. UCSF has a great health system and great college. American Lebanese Syrian Association Chair, Inc. Some of you might think, what the heck is that? I believe that's the legal name of St. Jude's, but someone should tell me if I'm wrong there. The Smithsonian, the Obama Foundation, Columbia, et cetera, et cetera. In 2022 to 2023, again, going down the list, a lot of colleges here, the Wildlife Conservation Society, the Nature Conservancy, some of these others as well. Where's the stock money coming from? New York, number one, at least in stock giving, not necessarily overall on everything, but certainly in stock giving. California, number two. Maryland, number three. Interesting. Part of that is how good Hopkins is at raising money, right? This is by where your organization is. DC, number six. Illinois, number four. Virginia, number five. Georgia, strong performance by Georgia. Texas, Missouri, et cetera. Pennsylvania, we see you as well, right? So what you see here, again, across the board, organizations like, states like Missouri, states like Pennsylvania, not as stock heavy as states like New York and California. And yet, when you're asking, you're getting. We noticed, we told you that larger nonprofits raise much more. You can see that here, how top heavy it is. Again, they have more people asking. And the secret here is it's not that complicated. You do not have to be Stanford to ask for stock gifts. We'll talk about that in a moment. Now, there's some really interesting data here. So we have some data of FreeWill partners who solicit stock gifts through our tools. And we have data for 03 and 04, and we have an early look at January of 25 compared to January of 24. So despite national declines, FreeWill partners actually saw a 140% increase in 23 to 22. It grew by another 18% in 2024. And what's happening here is more nonprofits are leveraging their smart giving suite to promote and secure stock gifts, driving growth in both the numbers of stock gifts and total raised. Among the top 10 sectors, FreeWill partners consistently outperform national trends, getting more and more gifts year over year. So you can see here, 2022 baseline 1.4x growth, and then another 18% growth in 2024. So really, really strong there. And then we look at, okay, we only have January data to know 2024 versus 2025, and 60% growth, right? 1.6x in terms of number of gifts here, 60% growth year over year from January to January. Now you might think, oh, is this people giving after the inauguration who are upset? We don't see any discernible trends in terms of where these orgs are, where the money's going. So we think it's actually just a factor of more people asking and strong market performance, in case that helps. Okay, strategies to grow stock giving just in time for tax season. So we're glad to do it now. Number one, this is obvious. It's still incredibly important, and some of you aren't doing it. Widespread promotion. Oh, very quick note before we get off of this. We don't share that FreeWill data because we just want to be cheerleaders for FreeWill, even though we do love FreeWill and we're very proud of the work we do. It really drives home this idea that when you're actively marketing and you're making it easy for people to give stock, people give a lot more. And you'll outperform all your peers who aren't doing that, right? So obviously we'd love to work with folks, but regardless of it, we want to make sure we're driving home this message that you should be asking for gifts, and you should be making it really easy for folks to give them to you. So strategy one here, Educate donors with mass outreach. Stock gifts take time, and donors often require multiple touch points before deciding to give. In your promotion, help donors understand the tax benefits of donating stock. This education piece is so important because most donors have not given stock previously. And the magic is that once they give it the first time, they'll be like, oh, wow, those benefits are incredible. And they'll continue to give that way potentially for the rest of their lives. There is a free AI-powered writing tool that we've made called Willy. We'll send out the link. The link will be in the slides when you get it. You can use this to craft a compelling tax-smart giving message. And we want to use multiple communication channels for promotion, which means in your direct mail, on your social media, in your email, and in particular, in your face-to-face conversations. We recommend 2 to 4 times a year in terms of touch points on the value of stock giving. Again, these are 150 times bigger than your cash gifts, so you want to be educating folks. It's a big win-win, et cetera. And these are the benefits that we've talked about already. All right. What are we doing here? We're sending emails 2 to 4 times per year along these elements. The best times to do it. Okay, the beginning and the end of the year, you've just missed January, but we're already starting our end of year planning in some cases. And tax season happening now through April. People are especially attuned to tax savings in this moment. If you're looking to get started in time for tax season, we have a toolkit that we've made especially for you, especially trying to get in the hands of as many people as possible. We will send it to you after the webinar. Second, the rise of stock giving on mobile devices and QR codes can be incredibly helpful here. So obviously 102 million people will be using QR scanners by 2026. Sometimes I think about QR codes being the big winners of COVID. It was sort of this useless technology that has become incredibly mainstream in a relatively short amount of time. So people aren't confused anymore. They can be integrated across multiple platforms, communication channels, and so social media posts, content, et cetera. We often have people use this at events. So if you're in person, it's a great chance to get people to learn about stock giving or even make stock gifts on the spot. What we don't want to do is just at these events say, okay, well, everyone just chip in $30 with your credit card when we could be missing out on $30,000 stock gifts. All right, so you have all this. Here's an example. Our friends at the Dravet Syndrome Foundation, this looks great. I mean, here's a brochure that they printed out. Obviously in person, this is folded into a trifold. You can see this. And there's great information here on stock giving. So an introduction to smart giving, it's a great asset. You see QCDs, you see donor advised funds, and you see stock gifts here. People can just QR code it. So really, really awesome work there. Third strategy, this is very important. You will be surprised how many people have their strategy ruined by a bad headline that doesn't actually make any difference. Do not let the market dictate when and how often you ask for stock gifts. Our reports show that stock giving and market performance are not inherently tied, and donors are not as tuned to fluctuations as you might assume. When the market is up, you should be asking. When the market is down, you should be asking. Now, here's the deal here, right? Yes, the market could be down 3 points from yesterday. It's not today, but it could be. People didn't buy stocks yesterday. They bought stocks 3 years ago, and the market's still up 80%. Or they bought stocks 30 years ago, and the market's up 8,000%. So do not let that dissuade you. It's very, very important. Most of your donors will have held stock for many years. Virtually all stock owners will have some appreciated assets unless they are the youngest of young. And so this is all there. Strategy 4, this is a can't miss thing that takes you basically no effort and should be implemented in every time you send a fundraising email. So please write this down. In all of your outreach, include this sentence. Will you chip in today to support whatever the mission is? And then put this, note, many people choose to give from their assets, stocks, gifts from their IRA, cryptocurrency, and grants from the donor advised funds to see even larger tax savings. Now, why does this work? 2 big reasons. One is, remember, these gifts are much bigger, right? DAF gifts are bigger, QCD gifts are bigger, crypto, if you want to include that, that's bigger. Stock gifts are 115 times bigger. But also we know from psychological research that these gifts, that reminding people of their assets leads to higher gifts even when they're just giving cash. So reminding people of their assets in an email will make them feel wealthier and will increase their giving regardless of what types of gifts they give. So this is a clutch thing to include. Again, it's one of these things that is very low effort, very high return, which is what we really try to focus on in sessions like this. Strategy 5, keep prioritizing donor advised funds. We know these are exploding. We know that they're getting a lot of stock gifts themselves, so there's a lot of assets in them. And we know that many of your previous stock donors are giving stock to DAFs, but many of your DAF donors would give you stock if you asked for them, right? So this is a really key component. Remind donors they're encouraged to give either way, but both of these gifts are much better to receive than cash gifts. All right. So we're going to wrap up there. Thank you so much. We hope this was really helpful. But before we drop off, I actually just want to call out one note in the chat that Kathy just put in here. So Kathy says another incentive for donors is to use stock to reset the cost basis. So just as a quick explanation here, let's say I own Google stock. I do own Google stock. Bought it in 2008. I was brilliant. Turns out I only bought $100 of it, so it's not as valuable as it could be. What I can do is I can give that stock away instead of giving cash and then buy that stock right back. So I still have the same portfolio and I no longer have any capital gains liability. Now, this is totally legal. It's strongly encouraged by financial advisors. It's a great strategy. So if anyone ever says, oh, but I think the stock is going to go up, we say, great, here's a really good opportunity there. It's a little bit more of a 201, 301 strategy, but just wanted to shout out the folks who share that with us. Okay, so thank you so much, Mike, for being here. My colleague Phoebe just dropped a link in the chat. So if you can click on that right now, this will be super helpful. It's the survey. First thing we're going to talk about is make sure we get you the slides and the recording. Second thing is, for those of you that are interested, this is the book we're going to give away to 20 folks. Morgan Housel, Psychology of Money. It is a great read. Some of you have already read it. Read it. Let me know what you learned from it. It's really valuable. So just make a note in the survey as well. Other things we will send to you in the survey: the tax season toolkit, stock donor email templates, and later this week, all attendees will receive a copy of the 2025 FreeWill stock report. So you'll get that in your hands. What's going to be in there is a lot more data based on geography, based on organization type, and based on organization size. So you can really use it to benchmark against what you're up to. The tax season toolkit, as you can see, it really gives you some strategies and has templates for things like how do I message about stock gifts, IRA gifts, et cetera. So you can download that. This can be quite helpful for folks. It's really important as people are thinking about maximizing donations over the next few months. Great resource here. And a big shout out to the team that put it together. On our side, we've also put together stock donor templates, right? So you probably want to make these a little bit more your own, but we've really set up the structure of it so that you can actually take about 10 minutes and make this great for yourself. A lot of people don't know where to start on this. And so again, if you're a FreeWill partner, great. If you're a FreeWill partner, we'll actually customize this for you. But otherwise, you have this. If you're not, we want to make sure that you're in a good position here. You can see some more examples here. Okay, what else is happening on Thursday? So in 2 days from today, we're going to be doing a deep dive on the FreeWill strategic support. So one of the things that a lot of people don't understand about FreeWill is we have a bunch of great technology. And when you become a partner, you actually also get a dedicated strategist who's helping you think through your plan giving strategy or your smart giving strategy, or in some cases, your grant outreach. And so this can be quite helpful. So come on Thursday and we'll hear from Jasmine, Nicole, Blair, and Brittany, all of whom have really special backgrounds before FreeWill, and also a little bit more deeper dive on strategy there. Last thing I want to say before we get to just a few minutes of questions, and we'll end a little bit early today. Thank you, Phoebe. There's also a link in the chat for anyone who wants to sign up for that directly. Next Wednesday, so we're doing extra duty here because there's so much changing in the world and we want to make sure we can be a resource. We're going to talk about some specific strategies for diversifying funding in uncertain times. So we know that what's going to happen is there will be a continuation of a lot of federal funding to nonprofits, but the shape of it may change. So we want to be really ready to engage in that. We know that when federal funding changes, foundation funding tends to change as well. And so we want to be ready to take advantage of new opportunities there. And then we know that when federal funding and times change, individual donor behavior changes. And so we need to be ready there. And so really looking at the available strategies there. And one of the other things we'll walk through next week, it's not quite ready this week, but it will be next week, is we're developing a really special tool to help you for free analyze your funding mix compared to peer organizations. So what you'll do is you'll enter your EIN, and it will match you against other organizations in similar areas of interest at similar sizes, and say, oh, you're actually much more dependent on membership fees than this other organization, which is getting more institutional funding or getting more donation dollars or what have you. And so it's a really interesting tool that we're working on right now. Again, totally free. Just in this moment, we want to make sure that you have all the strategies available to you in order to diversify funding. So come check it out. Special note, this is Wednesday and not Tuesday next week. So first Wednesday webinar in years. The reason we're doing that is because we have this fun talk at Stanford on Tuesday. So we're already booked up on Tuesday, but we wanted to slot this in and get it to you as opposed to waiting another week. So that's why that's happening. We would love to see you on the 19th. And if you need anything else, feel free to email me at patrick@freewill.com. There's a question in the survey, if you haven't already filled it out, that basically asks, hey, dream big, what can FreeWill do best to support you in the next few months? Please just think about that and let us know, or you can email me directly if you have thoughts. We're always sort of trying to look out for you and do what we can. We're lucky to have a really great team, technology-wise, expertise-wise, and so we know that a lot of you are feeling understaffed, under-resourced, and so anything we can do to support the community, we try to do. And so in that spirit, just a big shout out to, again, Phoebe put all her help, the whole marketing team that put together the stock report and the research, and our business intelligence team, which crunched just endless amounts of data. I mean, probably millions of cells of data to make that happen. And with that, we will see many of you Thursday. We will see some of you next Wednesday. And happy Black History Month. Happy Valentine's Day coming up. It seems like I should be making plans for that. And have a wonderful, wonderful week, and look forward to talking to you all very soon.